Hi and welcome, it's Steve Johnson here, Chief Investment Officer at Forager Funds. We'd planned this webinar for our International Shares Fund some time ago, but the timing could not have been more fortuitous in hindsight. They tell me stocks only go up in January. Well, that certainly hasn't been the case in 2022. It's been a pretty wild month. If you've read your quarterly report, you've probably noticed that the International Shares Fund was down about 12% for the 6 months to 31 December, so from the 30th of June to the 31st of December, and we're down another 8% or so in January, taking the total return from peak to trough to about minus 20%. It's not the first time that's happened in the history of this fund, and it's probably emblematic of a fairly wild market out there. Under the surface, the individual stock movements have been far more significant than that. We got an email last week from JP Morgan taking a look at the Russell 2000 index of small cap stocks in the US. It's also down about 20% from peak to current, but the average stock performance in that index is minus 39% from peak to current price, or that was at the 25th of January anyway. We've seen a bit of a bounce since then. We've seen that in our own portfolio. There are significant moves in a number of stocks where they're down 50, 60 and even more percent. I was sitting here in September regretting that we hadn't taken more money off the table at the 30th of June, asking ourselves a few questions. By the time December came along, and particularly through January, things have been getting very, very exciting in terms of cheap stock prices. In today's presentation, we're going to talk through some of those moves, what we could have done better last year, and far more importantly, what's exciting out there for us to be doing at the moment. And to talk you through that, here's Portfolio Manager Gareth Brown, and alongside him, Senior Analyst on our International Fund, Chloe Stokes. Take it away, Gareth.
Thanks, Steve. It's been a really tough 6 or 7 months for the fund against an increasingly difficult backdrop. As at 31 December, almost 40% of the stocks in the tech-heavy NASDAQ index were down more than 50% from their yearly high. For the broader small-cap focused Russell 2000 index, that figure's about a quarter down more than 50% from their yearly high. And things have clearly deteriorated over January as well. So this is becoming a proper rout, particularly in that smaller cap area where we have historically done very well over the long run. Also, faster growing businesses, tech-heavy businesses, and US generally have been difficult geography, difficult markets. Unfortunately, we've been caught up in that.
The broad theme has been that all of the stocks that performed really well in the first half of 2021 performed the worst in the second half. And you can see that in the crossover of our top 5 contributors in the first half and our top 5 detractors in the second half. The top 5 contributors are all smaller, growthier types of stocks. And 3 out of those 5 appear in our top 5 detractors in the second half of the year. The 2 that don't, Playboy and Celsius, definitely would have had we not been selling aggressively throughout the year.
We've definitely made steps in the right direction, bringing up that list again of the stocks that have performed very well for us in the first half of the year. We sold entirely out of a couple of them. We've sold very aggressively out of the other 3. Prices have come off a lot, and we really started selling these stocks back in sort of March, April last year. We've also pivoted the portfolio towards larger cap, more resilient businesses, more traditional value stocks. There are plenty of those towards the top of our portfolio list at the moment, and including some newer ones into the portfolio, such as Tesco.
Tesco is the largest grocery retailer in the UK. They've made some missteps in the past with bad acquisitions and also just struggling to compete with discount grocers like Aldi and Lidl. But that's all changed. They've been continuously improving their market share. They're focused on the core business and they have a great online offering that was made even more so throughout the pandemic. The stock's done relatively well for us over the past couple of months and it's still attractively valued at around 13 times earnings.
But I don't want to sugarcoat it. We've made some steps in the right direction, but those steps have been too slow and also not aggressive enough in terms of pivoting the portfolio away from things that had been successful towards more resilient businesses. And that really shows up in our relative results over the last 6 months. Drawdowns are a normal part of investing. This is the 5th time in our fund's relatively short 9-year life where the unit price has declined more than 10% from the recent high. It hurts, but it's also a normal part of investing. Generally speaking, falling share prices and lower share prices are good for the long-term investor. The lower your purchase price, the higher your future returns.
And while our performance was really good in that first half of the year, the process of looking for new ideas was frustrating. We would find something that we thought looked interesting, and in the couple of days to a week it takes to put the research together, the price would shoot up 15 or 20%. Now we're looking at our bench list of ideas, and a lot of them are starting to look attractive again. We're splitting the opportunities that we're focused on at the moment into 3 broad categories: stocks that we used to own, stocks that we currently own but could own more of, and wishlist stocks.
So we're looking very closely at those businesses that we've owned in the past and we've sold out of. We keep up to date with them, and it's an area we look at closely as markets hit turmoil. 3 examples up on the screen that are probably the best illustrations of that: Farfetch, Celsius, and GAN. We've spent a lot of time on them in recent months. We recently acquired a small new position in Celsius. This is a very rapidly growing drinks business that we've made a genuine fortune out of over the last 2 years, and we traded the ebbs and flows in share price particularly well. The economics of this business, the economics of the drinks business, when you are the winner, is very, very attractive, and we like the economics there, and we think the price makes sense again. As for GAN, this is a software provider that provides back-end software for gambling companies to manage their business. We sold out at much, much higher prices than today. I've been following the story since. Ultimately, we've opted for a cleaner, pure, and I think safer play here in Flutter, which we'll get to in a moment.
We've also been looking very closely at some of the stocks we already own, and we're just waiting to see whether a couple of things go right or the share price falls a bit further. The ones that we're most interested in have already fallen significantly. Most of them are profitable, and we think that the valuation makes some of the falls look quite excessive. We don't know how this is going to pan out, but historically we've been good at concentrating into our best ideas at times of market turmoil, and that's what we're trying to do again this time.
The other area we're spending a lot of time is wishlist stocks. We always have a long bench of ideas that we would enthusiastically own at the right price and in the right situation. So when market turmoil comes, we need to go back and refresh those valuations and make sure we're not missing anything. We have acquired a few positions that fit that category over the past month or so. We hope to add more in the months ahead. Flutter is a new position, and it's one of our largest positions. This is an industry we've known very well for years. We know the assets particularly well. The stock's been on our radar for years. It's the 40% pullback in share price over the last few months of 2021 that really caught our attention. We've outlined the investment case in more detail in our December quarterly if you'd like to have a read. But this is a business that owns the market-leading online sports betting sites in Australia, in the UK, and in the very immature but rapidly growing US market. I think the US market is the most interesting part of this business because it's where valuations can be wrong. The US market is currently in the early land rush days where all the competitors are throwing a lot of incentives and a lot of marketing dollars trying to win that customer that will then stay with them for a few years' time. It looks like a bloodbath. It is a bloodbath. This is how it always goes. We know from experience elsewhere in the world that what happens, the smaller competitors start falling away, which we've seen a bit of evidence already in the US. The market consolidates around maybe a handful of big players, the largest of which in particular becomes really profitable. And it's a business where winner takes most. We're very confident that Flutter will end up with a market leading, or one of the market leading positions in each of the states in which it operates, and will probably be the largest player in most of the markets it operates, which is a great place to start making money.
Another example is InMode. They design medical aesthetic platforms. So think somebody who wants the results of plastic surgery, but without any of the incisions or the downtime. We started looking at this stock in around July last year, and within a week or so, the price had shot up 20%. So we'd lost what we thought was our margin of safety. Then, over the next couple of months, the share price doubled, and we thought we'd definitely missed the opportunity to have it in the portfolio. But it's a really interesting and innovative business. They've been growing their revenues really significantly at high margins, and they're super profitable. So I've been following it closely. Over the past couple of months, that share price has dropped more than 50%. So the valuation is starting to look attractive again at around 20 times earnings. It's a different situation to Flutter though. We're just taking baby steps into this position, and it's quite small for us at the moment, but watch this space.
Look, it's a small position in Mode, but we mention it here because I think it's quite illustrative of why we get excited about market turmoil. It's a really high quality business. We've had it on our list for a long time. Finally, we get an opportunity to own it. So this is why we get excited coming to work in times like this. Anyhow, thanks, Chloe. It's been a really tough 6 or 7 months for the fund, and there's no doubt that we could have played it better. But these falls are getting more serious, and we're starting to find them quite interesting. So we are pivoting the portfolio towards those opportunities, concentrating them in the ones that we think have the highest risk-adjusted returns. And we're also starting to deploy some of the excess cash that's been sitting in the fund's accounts over, again, that 6 or 7 month period. We're finding new opportunities and old opportunities to use that cash. That said, this route could get worse, and we certainly haven't fired all our bullets at this stage. We're looking forward to that kind of environment should it develop. Back to you, Steve.
Thanks, Gareth and Chloe. We'll get them both back for the Q&A, and if you've got some questions in mind, you can start putting those into the Q&A box already. It's really important in this business to learn but not overreact to what are inevitable periods of underperformance. In my CEO letter in our quarterly report, I was actually lamenting the fact that we had sold some of our best performers in the Australian fund too early, only to watch them go up 50%. In this fund, we didn't do enough selling. You're never going to be right 100% of the time. And for the most part, we did not sell all of these businesses because they have been performing spectacularly well. One of my favourite examples is a little company called Fathom Holdings. This is an online real estate business in the US, and we actually participated in this company's IPO back in mid-2020. Back then, the company was half the size it is today, and they had some big growth plans and an owner-manager in that business that we thought was a good guy to back to grow the business a lot. The share price went from $10 at the IPO up to $50 and then all the way back to $12 in January this year. In the meantime, the revenue has more than doubled. The number of agents using its platform is up almost 100%. And they're guiding next year to some $400 million of revenue relative to a current market capitalisation of $200 million. This is still a young business and there's still lots of potential futures to unfold, but it's less risky today than it was 12 months ago, and we're buying it at almost the same price. These sorts of opportunities are pretty widespread out there at the moment in a small cap land that has been pummeled. We're off to a conference in the US in March. We attended it virtually last year and had to sift through 500-600 different companies and attend a whole heap of presentations where the share price was up 100 and 200% in the year before, and frankly, it was quite boring. We've just been going through the list for this year, and there's a lot of share prices in there that are down 70 and 80%. Now, some of these companies are not worth very much money at all, but the widespread nature of the selling is creating a lot of opportunities out there. Gareth and Chloe already had this slide up. Drawdowns like we've seen over the past 6 and 7 months are not just inevitable, they should be welcomed. They're part and parcel of investing in a fund that invests in a lot of small cap stocks and does so in a fairly concentrated way. You should welcome them because they're our opportunity to get out there and add substantial amounts of value over the medium and longer term. We need cheap stock prices for us to create extra and exceptional returns. I've got the table up here of the fund returns since inception, and this is to the end of December. You can see the fund here has returned 16% per annum over what is almost 9 years now after all fees and costs. Now, by the end of January, that might be 15% per annum instead of 16% per annum, but the opportunity set in front of us today is significantly better than it was 6 or 7 months ago. And we need that opportunity set to keep generating returns like this. Something else significant happened over the past 12 months, and that was a substantial equity transaction in the Forager Funds Management Company. We had a number of external shareholders in Forager that sold their investment in the company, and the vast majority of those sales were picked up by staff. The people working on this fund, particularly Gareth and Harvey, are now meaningful equity holders in the Forager Funds Management business, and Chloe and the other staff in the business picked up some shares as part of their performance remuneration as well. We are far better aligned from a staff perspective, and we have a good, stable team here that has been working together very closely for the past 3 years and generating some outstanding results. I know a lot of you have been watching this from the sidelines, or you've dipped a toe in the water and were sitting there in June of last year feeling like you've missed the boat. Well, this is the pullback that you've been waiting for, and it's the opportunity for you to join us on what we think is going to be a successful 5 and 10 year journey from here. That's by no means a guarantee that we've seen the bottom. Stock prices can fall further and harder than what we've seen so far, but it's a far more attractive entry point than it was 6 and 7 months ago. I'm putting a bit more of my own money into the fund this week, and we've had a number of investors, both new and existing, adding to their investment over the past couple of weeks, and I think it's an attractive time to be doing so. With that, we'll flick over to the Q&A. We'll have a quick 30-second break here while we get Gareth and Chloe back on screen and give you some time to enter some questions into the sidebar. We'll be back in 30 seconds. Welcome back. First question we've got here is from Josh, and Josh says he's surprised by the small weightings of the top 5 holdings relative to other funds. Would you expect the current concentration of the top 5 to remain similar over time? Maybe you can kick off with that one, Gareth.
My answer to that is broadly, we want to be concentrated when we get paid to be concentrated, and when we're less certain about outcomes, or when we're finding a wider opportunity set, we can get diversified without hurting returns too much. I think, generally speaking, in tougher markets where things are priced expensively, we will be more diversified. And as markets get cheaper, we will be more concentrated. That's a rough rule of thumb. And we are definitely looking for those opportunities through this reporting season to concentrate in the ideas that are really coming together and working well, and maybe cast off other opportunities. So I would suggest it's fairly normal, where we've got sort of 5 positions now with 4 to 5% type weightings. That would be a fairly normal experience, but we will happily own more concentrated portfolio at times, and we will look for that opportunity.
Yeah, Chloe, do you have any thoughts on what you'd be looking for higher weightings in some of the stuff that you're looking at out there? Because I do think generally we would like large weightings in our best ideas.
So we definitely want a lot of upside in the positions that we have at the top of the portfolio, but at the same time, we also need to have a lot more certainty. So it's quite hard to find those positions at the moment where we think there is a lot of upside at current prices, but we also feel really comfortable over what we think is going to happen over the medium term.
Yeah, I think that's absolutely right. It's probably a function at the moment of the nature of the turmoil that's out there. It is largely in the small cap space. They tend to be riskier businesses, and there are a lot of them at the moment. So to the extent that we can diversify the risk of any one business not delivering what we hope, then that is a good thing. To the extent that it became a very wide market route, that there are larger, safer businesses trading at very attractive prices, you should still expect to see 5, 6 and 7% weightings in this portfolio. Gareth, you've recently added Flutter to the portfolio in a fairly big weighting. That's a more than 4% weighting straight away for us. Because of the diverse, proven nature of that business. It's underpinned by operations that have been around for a very long time. There's a speculative component to it, but we're not paying a lot for it.
Yeah, there's parts of that valuation that depend on businesses in the UK and in Australia that we know very, very well, that we're very familiar with, and we're comfortable enough to have a fairly large weighting for an initial position.
Yeah, and this is also a really important reporting season for us as these companies give 2022 guidance. There's a few stocks in here that are really exceptionally cheap in our view, but quite young. And the more information that we can get about their path, the more confident we're going to get upping those sizes. So as an investor in the fund, you should expect to see some quite significant change over time there in terms of what our largest weightings look like. Mahaneshwar says, why not consider choosing a couple of stocks that you trade more frequently, I assume he's saying here, especially stocks that swing 10% on some days, or allocate 10% of fund for such trading strategies. Look, I think the volatility has created the ability for us to do that. A stock like Celsius, we've just bought this stock for the third time. It's gone to a 0% weighting twice. We made an initial investment in it, made a lot of money, sold out of all of it because of valuation concerns. The business has still been growing like crazy. Yeah. We bought it again, we sold it again, we've recently just bought it again. I wouldn't necessarily say that's intraday trading or anything, but certainly the turnover in the portfolio has been substantially higher than you and I have historically had, yes, simply because of the price moves.
And yeah, I think we've been paid well to trade the portfolio over the last year or two, just with the volatility. We've been able to find cheap stocks to replace ones that we didn't want to own anymore, or we wanted to sell down in. So we don't have a bucket like that, but you will see us doing more trading in and out of things when the opportunities are there.
Yeah, and it is important to recognise this is a very small, nimble fund. It's still 250 million Australian dollars. So we want to do something that's 1% of the fund. That's $2.5 million worth of trading. In small cap land, it's not easy to do that in and out on the same day in that many stocks. So we're largely focused on longer term returns here, because at our size, trying to do that in the short term in a lot of stocks is typically counterproductive.
That's our skill set as well.
Another question for you here, Gareth. Is Twitter still in the fund? How do you assess it now? Does Jack Dorsey's departure change things? And once Gareth's done with that, we might come to you on Pinterest, because I think they're both suffering from some similar market sentiment issues.
So yes, Twitter's in the fund. It's now a sort of among probably the 10th largest position in the fund now. That's due to the price fall. I've been surprised by the scope of it. The last few quarters, the results have been falling into place with my expectations. It is, Jack Dorsey's departure, I wasn't surprised that in the end the price fell on that. I think everyone was looking for it to increase. It didn't sort of surprise me, but it has been caught up in the same sort of high growth tech world sell-off. I'm really excited about the next couple of quarters results, and if they don't perform to my expectations, it's something that we may end up trading out of. But everything's been falling into place. It is the price has gotten cheaper. We haven't committed any more capital to it at this stage, though. It's in the penalty box.
Yeah, and I would put it in that bucket that I was talking about. Although it's already a fairly large weighting, it's a stock that we want to see more evidence. So we've got a thesis. We've seen some evidence for that thesis. We've probably seen a little bit of contra evidence that the margins there are not necessarily going the way that we want. We want to see more evidence, and I think that's you never get a free look at these things, right? The share price might be up by the time that happens, but we would just like a bit more confidence that our thesis is right here before upping the position significantly. Probably true of Pinterest as well.
Absolutely, and we have obviously seen that selling off with the rest of the growth stocks, but it started long before that. The market's pretty concerned about user growth, especially in the US, which is definitely a factor that we're considering, but we're really focused on revenue growth overall, which they're doing a really impressive job at. They're posting some great revenue numbers, because while their user growth is slowing pretty significantly, they had a huge bump from people staying in during the pandemic. They're growing their advertising per user at phenomenal rates. So revenue's growing really well. And it's actually quite different to other social media platforms in that it's project based. So you're on there looking at your wedding or your house renovation. You're not necessarily spending half an hour a day on there like you would Instagram or TikTok or Facebook. One thing I've been really impressed with though, and I hope to keep seeing, is just the profitability of this business at such early stages. So hopefully we see more of that.
Very interesting space. You'll see we've added Facebook to the portfolio recently as well, which is a giant behemoth, a bit of a proxy, but has also been suffering from some of the same concerns around Apple's changes, and a very strong result from Alphabet last night. So hopefully Facebook follows that with something similar tomorrow, and the whole ecosystem I still think is very healthy. If the amount of time I see people spending on these things these days is any guide, and I think there's still lots of monetization opportunities. Sylvian says, where is Harvey Magotti? Haven't seen him on the YouTube channel. Does he not like whiskey? And then on gambling stocks, have you had a look at FDJ?
I think he drinks whiskey, doesn't he? I've not had a whiskey with him before.
He's Croatian. They drink anything.
So, it's midday. Harvey's usually asleep at this time. He works till typically 3 or 4 in the morning. And it's been a very volatile month, and it's been useful having someone up overnight to keep an eye on things. I think that's the main reason he's not here today. We'll make sure he gets on the next one, and maybe I'll take a break. Yeah,
look, he'll be back. We're very, very busy at the moment, and my priority is getting people working on finding new stock ideas rather than recording videos and things. So I'm taking up as much of the slack there as I can and keeping the team out there looking for stocks, but he's completely fine.
FDJ, you've had a look at it before. I've had a bit of a look at it. Is it worth mentioning?
You can talk about it, yep.
Yeah, this is the French lottery provider. It's an interesting business. It's maybe not at the pointy end like Neo Games that we have owned we do own in that space, which provides systems. FDJ runs the lotteries over in France. It just wasn't cheap enough to grab me. I think that was the conclusion I came to.
Yeah, I feel like we were working really hard August, September last year to find some very boring, resilient businesses in a market that we thought was quite expensive, and I thought it was a potential candidate for that type of low risk 7-8% return type business. I think in this environment it's probably less interesting to us relatively. Will the international fund have a DRP for the distribution? It most certainly will. That'll be a June distribution. As you know, this fund's been around for 9 years. The distributions are very, very, very correlated with the fund returns. We paid out a truckload of distribution last year because we realised all of those gains. As things stand at the moment, you should expect that to be a very small number this year, so it won't be a large distribution while ever the returns are negative for the year.
I think it's fair to say we're likely always to have a DRP in the unit trust here with the international fund. The problem with the Aussie fund is that it can trade at a big discount to net asset value, and so there you water down other people's holdings by having a DRP if you do it at the discount. So it's not a problem in the international fund. I don't foresee it being an issue.
Look, Chloe, you can chime in on this one. This is a question from Ronald. I'm going to paraphrase it a little bit because it's a topic or a conversation that we've been having a lot. He said Gareth refers to the allocation to companies with good risk-adjusted returns. What percentage of the portfolio is in the higher risk, higher return? And I think that's where all of the turmoil has been over the past 6 months. How are we thinking about the overall portfolio allocation to the space rather than just the individual opportunities? Any thoughts there, Chloe or Gareth?
I mean, rule of thumb, a third quite safe, a third riskier, and a third quite pointy is probably where we're at the moment. And I don't, we've sort of, some of the more pointy ones have gotten cheaper over the last few months, obviously, so that allocation's come down a bit.
Shrunk naturally, yeah.
And we've done some rebalancing there in the, 6 months prior, but that's probably a decent rule of thumb.
Yeah, look, I am really keen to see that change as opportunities become more abundant, though. I've just been on a week's holiday and sent the team an email prior to it saying we want higher allocations to this stuff at much cheaper prices. So the pressure from me to the team is to make sure we're moving in the right direction. We've certainly done that over the past few weeks. One thing I'm really worried about at the moment is that all this stuff runs away really quickly. I've said a number of times in this presentation, we're really keen to see the full year results for these companies and any guidance for for 2022, it's a risk here that some of these things that we want bigger weightings in, if we can get that higher confidence run away from us in the interim. So we've definitely, increased the allocation over the past couple of weeks, touched on adding some stocks like InMode that you talked on in your presentation, Celsius back in the portfolio. So it's going up, and there's really no limit to it. I think that roughly a third is right, but if the opportunities get really extreme, there should be no reason it's not 50%, 60% of the portfolio. He's also added, has Steve shrunk owing to COVID, or has Gareth grown with his additional equity in the business? I don't know.
Is that better?
There's another question about the COVID. I am back to feeling 100%. It took a while to get out of my system. For those who haven't listened to the podcast that Gareth and I started recording, I did have a bout of COVID in early January. It hung around the system for a while. It was 10 or 11 days for me before it went away, but back to feeling 100% now. Can investors borrow against Forager International Shares Fund? I think that depends on your provider. And I would also add, you've seen the volatility in the returns of this fund over the past years. We run a concentrated portfolio. Our aim is to make big returns, but they're probably going to come in a lumpy fashion. So putting my general advice hat on, I probably wouldn't be thinking of this as something that's particularly suitable to be leveraged. Bruce asked a question about ESG issues. Chloe, we had a long chat at an offsite just prior to Christmas, and I think we came up with a team view on this controversial issue. What is it?
Well, we definitely factor ESG into our research process. We have a huge section of it where we talk about all the different types of ESG risks and how we're factoring them into our valuation. But what we've always had that I think people tend to forget is a big part of ESG is a governance section, which is actually a big focus for us when we're investing in any type of company. So we've always been really focused on making sure that we're comfortable with the governance, and potentially in cases we're not, that we're getting really well compensated for it. Yeah.
But our primary focus is really on returns here, and making a really important part of returns is that the business itself is sustainable. But we will largely invest across the spectrum of stocks that are listed if we think that business is sustainable. I've used casinos as an example in the past. I don't think the Sydney Casino is going anywhere in terms of the license that they've got and the profits that they make, and we are happy to invest in that business on that basis. And I actually think one of the things in the world that's happening at the moment is this starving of capital of certain types of businesses is creating some really interesting opportunities for investors where you don't need to provide new capital to a coal mine or an oil producer, but where the prices are going to be substantially higher because of that. So if you're an investor in this fund, you should expect our primary focus to be on excess returns, and that may come in some businesses that wouldn't be in an ethical fund typically. Peters has asked a question about whether we've had net redemptions in recent months. We have not. We've had net inflows over recent months. I've been
fairly small.
Quite happy though to see a number of new people coming on board. We've recently been added to the Macquarie Wrap, if anyone's on that. It's been a source of investments for us. But as I said in my part of the presentation, I do think a lot of people have been sitting there nervous about the 90% return that we made in the 2021 financial year, and we were all sitting around this table nervous about how quickly everything was going up as well. So there are people out there seeing this as an opportunity, including myself. And there are people that have had a bad experience because they came in at 30 June, and I always struggle personally with people that have that bad initial experience because I know that it's very emotionally difficult, but we have had some very short-term withdrawals across the client base from people that very recently put their money in, which is the most unfortunate part for me of drawdowns like this, because I know if we can get people to the 3 and 4 year mark, they're going to have had a much better experience and much more tolerant of the drawdowns that are inevitable in this type of investing. Graham says, some commentators suggesting Australian equities are a better place to hide than international. You sound bullish on international, but if market wobbles do continue, is there merit in the idea that the falls may be more limited in Australia? I actually am quite bullish about the Australian stock market because of its weight. Well, I'll retrace that and say 3 months ago, I think relatively, banks, resource companies were attractively valued relative to very, very highly priced tech stocks. And I'd said that in a number of places, including on Livewire. I think in this small cap space, that trade-off has changed quite dramatically over the past few months. And one conversation I've had with a few people recently is that these individual stocks can bottom out a long time before the overall market bottoms out. I don't feel like this tech bubble is going to be properly burst until Tesla's half the price that it is today, rather than still trading at $900. We're not at a point where there's widespread distress out there, but we have seen 70 and 80% falls in individual stocks. And back in 2008-9, my largest investment was the old Rams Home Loans, RHG, and it hit its share price low 30 June 2008, which would have been a lot of tax loss selling leading into the year. But by the time the overall market had hit its bottom, which was March 2009, so a full 9 months after RHG had hit its lows, RHG was back up 3- and 4-fold from its bottom. And I think it's highly likely that you're going to see that. If we're right about the valuations of these businesses, it's going to become really obviously very quickly that some of them are exceptionally cheap. So I don't think we need to see the markets hitting lows for us to be doing well out of the environment that's out there at the moment.
That year 2000 sell-off was also probably interesting. It's probably more analogous to 2000 than 2008, the current market, where we've got some overpriced growth in tech and some values, some more traditional value stocks that are relatively reasonably priced. And back in that period of time, I was buying cheap, good stocks all through 1999, all through 2000, really through most of 2001 as well. And you did very well. You didn't really have to watch the NASDAQ, if that makes sense. There were other things to do. Now we can find those traditional opportunities, but when the growthier stocks get cheap enough, we'll commit more to it. The more bifurcated market is what I was trying to say.
Yep. 2 questions here from John and Will about Chinese market and the sell-off that we've seen over the past 12 to 18 months. Again, another frequent topic of conversation in the team, but not something that we've done much with. Any thoughts on that one?
We just have enough opportunities, and especially at the moment, to be looking at in the markets that we're much more comfortable in, like the US and Europe and the UK. I mean, if the opportunities dried up there, maybe we would think about it a bit more, but we honestly don't even have time to go through all of the stocks that are down in the markets we're really comfortable in. What we do have, though, that we look at is something like a Farfetch that has a lot of exposure to China. A lot of the upside in that business's operational future is if things go well in China, and it also got hammered when everything was happening over with the Chinese economy. So there are businesses like that we'll look at, things that we've owned in the past, but we're not specifically focusing on China, no.
I've historically said that I think psychology is 80% of the return that you can generate from the markets, and that you could make money in the stock market without ever looking at a P&L and a balance sheet. And that for me is just all around the setup. Just go and look for distress, for people selling indiscriminately, and just buy it, and you'll probably do okay doing that. I feel like China's been a bit like that over the past 3 to 4 months. It's gone from the darling market that everyone says, you can't invest without owning it, to people saying it's completely uninvestable and you can't own it. And I think there should be a governance discount there, and I think you should be paying half the price for the same business in China that you would pay in the US, because the government has shown repeatedly that they're going to do things that dramatically change the value of what you own. So I think the setup there is probably right for doing okay. I've also got a lot of scar tissue from investing in that part of the world. I found that we don't have the individual edge as investors, that we find it hard, even if you get the market right, to pick the right stocks, and that we're finding lots of opportunities elsewhere in the world that I feel really comfortable with the governance and how the cash flow is going to come out of that business over time, that we haven't done anything and we probably won't do anything, I'd say, is our current bent towards that part of the world, simply because it's too hard. But if you do feel confident and you feel like it's a space that you understand and know well, I think the setup is right for people to be making money there. What would be a rough limit on a single position in the fund?
I mean, we've had double digits, so more than 10%. We have never committed 10% of the fund's capital position, but it promptly doubles. We still think it's cheap, but it's not going to be 20. I can't see it. But
and I think it's probably gone
down.
Hopefully, I think our idea generation capacity and the team that we've got now and the experience that team has got, I think in a perfect world, you have more really good ideas and you have a bit less in each of them. And hopefully we can get to that point. But I think when we get this right, like we did with Blanco when it was a double-digit percentage stock for us, we bought that very cheap. We had a big investment in it. It did exceptionally well for us, and not selling some of those things too early is really important. So don't be surprised if you see another 10% position in the portfolio at some point down the track. Really good question here about dollar cost averaging. For someone who has capital, is it advisable to invest now as a lump sum or gradually over the next 6 months? My advice on this is always think about your own psychology. I think the risk of going in one lump sum is you wake up in 3 weeks' time and you're sitting there saying, I could have done it 5% cheaper or 10% cheaper, and that causes you a significant amount of angst. There's as much risk that everything's up 5 or 10%, so that dollar cost averaging costs you money. So I think if you're someone that is really comfortable with that feeling's not going to distress you in a few weeks' time, then lump sum is just as effective as overtime. But doing it over time is a way of spreading that exposure out, and I think spreading your emotional anxiety that you might have about a drawdown in the initial period of your investment. So I do use it with people that I think are feeling really nervous, especially if they're a bit new to investing or they've just saved up some money and it's a significant transaction for them. I think emotionally it's not a bad idea to spread that out over time. Portfolio's allocation to cash at the moment, that can be a quick one for you, Chloe. Where are we roughly?
5%.
Touch over 5. Yeah.
5.
We've put a little bit of money to work in the last few days in some of the smaller, growthier things, just because the opportunity has been good. We had sort of 7%, 8% cash a couple of weeks ago, and that's come down. We probably aren't going to zero in this environment. It would need to be cheaper again.
I'd also look at stocks like Facebook in the portfolio, Zebra, even CDW. There's some bigger defensive businesses in there that we expect to make good returns out of over time, but if we see the opportunities for exceptional returns, they're sitting there as very, very liquid alternatives for us to take that money and invest in other things. So that cash weighting might stay at 5 for us to be really nimble, but the weighting of other large cap stuff comes down if we keep seeing opportunities or, again, get more confidence about some of our theses. Look, Bruce has got a really insightful question, I think, here. What is the situation of owning Forager shares against investing in the fund? And I think he's getting there at people who are working in the fund. Is it better for them to have money in the fund, or is it better for them to have money in the Forager business? We have thought a lot about that question at a board level. I would like to see both over time, and certainly with Gareth, we've got both. Chloe's got an investment in the fund as well. I want to see people doing both over time. I've had a very strong view that a small boutique funds management business should be majority owned by staff for a long time, and our ownership structure was a function of our history with Intelligent Investor rather than something we sat down with on day one, and I wanted to get that staff equity ownership up. So when the opportunity came up for this transaction with the external shareholders, for me that was an opportunity. For my main priority is to get people long-term committed to this business with an equity stake in it and very focused on our performance and performance fees and growth over time. And hopefully from here we see a combination of equity in the business and investment in the funds as well. We'll do 2 more quick questions. Clarence says, what's the best lesson learnt over the past year? 1 each.
I feel like it's almost the same lesson that I learnt during COVID, and I've learnt it again, and it's the value in having a really good bench list of stocks with valuations that you want to buy them, even if you think they're too expensive, because you get market crashes like this, they happen so fast, and you want to be able to pounce.
I don't know if it's been learned, but we've said several times, for example, in the quarterly, that we directionally got this right, but we didn't get the magnitude right, that we sold 50, 60, 70% of our holdings in a lot of these fast-growing stocks over the last 12 months, but we should have sold 100. And I guess once you pick the direction, sit down, am I getting the magnitude right? Should I be doing this more aggressively? Whether I'm selling, whether I'm buying, whatever it is I'm doing, I have a feeling here about what the valuations are telling me? Have I got the magnitude right? That's really the portfolio management question. And I think we've gotten that wrong or incorrect in certain instances this year, and making sure we think of that magnitude as really almost as a separate part of the question of what to do.
Yeah. That Phil Tetlock book, Super Forecasters, it's one of my favourite books for people who haven't read it. He talks a lot in there about people that are really, really good at forecasting things, most of the time making gradual changes to their estimates. I'm trying to forecast inflation and the price of used cars is up 10%, so I'm going to nudge that a little bit. And they mostly spend their time nudging things around, but they're also very, very good at recognising seismic changes in something that's happened. I thought this was a 30% probability. Something has happened. Everyone else is now assuming it's 40, but it should be 70 or it should be 80. And they really change their forecast. They recognise when something is significant. And I think that's true in portfolio management as well. Most of the time, the share price is up a bit or it's down a bit. There's a bit of an opportunity here. We want to be making fairly small changes to the portfolio. Sometimes big things happen and we need to make more seismic moves than we've made over the past 12 months. And that big thing was, a crazy run up in the valuations of some of these small cap stocks where we're sitting there saying our business is going great. We're going to sell it because the price is up, but the magnitude of the price moves was far more dramatic than the magnitude of our valuation moves.
Yeah, and you sold 2/3 of your position. It feels like you've done something dramatic, but you've still got 1/3 in there at much higher valuations.
And when you've got 10 of them,
then,
it adds up to 20% of the portfolio, which is more than half. And that's how what's happened has happened. I've been talking a lot about this. I wrote the quarterly report about it. I really think strongly that this is such a difficult business to learn permanent lessons from. I almost think every single lesson that you learn at a particular point in time, it's not the right time to be applying it at the time that you've just learnt it. I think this is probably a time, given what's happened, for people to be thinking about some of these small cap growth stocks and saying they actually are now businesses that you want to hold for 5 or 10 years and not be learning the lesson or not applying the lesson that you should have sold it at today's prices, that's for sure. Tamika's giving me the Japanese crossed arms manoeuvre, so we might wrap up today's webinar there. That's a really great list of questions, everyone. Thanks for tuning in. It's been a good day today. We'll get the video up on YouTube and you can share it with anyone who's missed it. Please, any further questions, give us a call, send us an email, or you can follow us on Twitter or any other social media. And if you haven't already checked it out, Gareth and his podcast seems to be going pretty well in terms of downloads, and we've had some great feedback and put a bit of work into it. So if you're a podcast listener, get onto it on all of your favourite podcast apps. Thanks for tuning in.